Two-thirds of construction companies are unsaleable. So how do you structure a construction company so that it can be sold either internally or externally? That is the topic of conversation today with my guests, Matt Drake and Scott Duncan. They are co-founders of BaseRock Partners, an investment bank that serves the engineering and construction industries. There's three main things that we talk about here today: how to structure your company, how to grow your company, and the different options that are available to you for selling your company. We go into detail on the specific steps that you need to take years before any kind of transaction in order to set yourself up for success. So we're going to have tons of practical insight and advice. And I want to thank Scott and Matt for coming on the show and sharing their experience. There's links in the show notes to how you can get in touch with them. So enjoy my conversation today with Matt and Scott. Give us a rating or a review wherever you get your podcasts, and feel free to share this show with other folks. This is Eric Anderton, and you're listening to Construction Genius, a leadership masterclass. Thomas Edison said that genius is 1% inspiration and 99% perspiration. If you're a construction leader, you know all about the perspiration, and this show is all about the 1% inspiration that you can add to your hard work to help you to improve your leadership. Matt, Scott, welcome to Construction Genius.
Yeah, great to be
Thanks
here.
for having us.
Awesome. You know, it's really interesting. Both of us, we work with a lot of construction companies around succession planning issues. And there's a stunning statistic out there that 2/3 of construction companies are not saleable. Can you tell me why that is?
Sure, I'm happy to start with that one. It's a function of the fact that barriers to entry in construction markets are exceptionally low most of the time.
Mm-hmm.
If you would like to start a construction business, the old phrase is all you need is a shovel and a pickup truck to get into business. And so with the barriers to entry in the construction market being so low, it causes a lot of buyers to look through the lens of buy versus build as they're thinking about expanding their operations. And to give you an example of that, if I want to get into your market as a GC and I want to get into Sacramento, I'm going to look at it as, do I go buy somebody? And typically, if you're going to go buy somebody, they want a premium for their business. Or do I go send some of my best employees and a manager over there to open operations in Sacramento? And so when you begin looking through that lens with the very limited barriers to entry in most markets, it really depresses valuations and makes most companies unsaleable.
Interesting. Matt, what are your thoughts on that?
Yeah, I mean, I agree. Scott and I, we live this every day with our clients, educating them on their options, and I think a lot of them have a tough time swallowing that pill, which maybe they're not saleable, right? We're not talking about all contractors, right? There's very specific contractors that are very much in high demand, but for the majority of contractors, if you're going to look to exit your business, you probably are going to have to figure out some other solution than third-party sale. And it's for all those reasons. But it's very unique in our industry compared to other industries. And I don't have the statistics for other industries. I just know that it's much higher. You're going to be able to, you're going to have much more saleable companies in other industries. A big part of that too, Eric, is private equity plays a very small role in our industry. And they do play a role, but they play a very small role compared to other industries. And if you think about it, private equity is 50% of the M&A market, right? So if you take away 50% of the M&A market, not the entire 50%, but a majority of it, you're really left with very limited buyers, right? And so it just creates, supply and demand is how M&A works. And if you've got the supply but not the demand, you've got to look elsewhere sometimes for options.
So in go ahead, please.
One other point I was going to make, Eric, is that there's over 800,000 contractors in the United States, and if you look at most of them, they tend to be pretty small businesses where the sole proprietor is the guy who is really running the business. He is looking at every day at operations. He's approving contracts. He's estimating contracts. All of that stuff. And so, if he wants to retire, what do you really buy? And so that becomes such a key part of the acquisition process if you're evaluating your options, from a sale perspective, that what are you truly selling? And so we work very closely with folks thinking about leadership development, getting people into a role where your business does become a little bit more valuable because you've got a good cohesive management team that can live on beyond just one key sole proprietor.
Okay, so let's start to explore that then. The reality is that many construction companies are not saleable. In your experiences, what distinguishes those companies that are saleable, whether it is internally or externally?
Absolutely. So what I would start with is the more of a niche the business is in, the more saleable will be. And what I mean by a niche is you are in a market where you have, for example, a key customer with call it a long-term relationship and call it a sticky relationship with a client. We see that a lot in, for example, utility T&D markets where you have an MSA, master service agreement with, for example, a PG&E or somebody like that, where you're going to have some element of recurring revenue that continues to come forward and people can begin to predict that. Yeah. I would also say that, as we just talked about, if you've got a really strong management team where if the owner retires, it's not going to affect operations in the least, that is a huge benefit where more and more buyers will look at that kind of opportunity. And I'll also say, to Matt's point on the private equity side, with all of the discussion around infrastructure in Washington and among the states, we're seeing a lot more interest from private equity in infrastructure related markets. But one thing that really slows down the private equity interest in construction is the concept of bonded revenue. Mm-hmm. And so if you have a surety component to your work, what it does is really limits the capital structure that private equity firms can utilize to come in and buy a business. And that's one of the values that they think they provide to companies, is being able, one of the ways they really maximize returns is how I should phrase it, is they'll come in and pay 6 or 8 times for a business, but put 2 or 3 turns of leverage on that company so they really juice up their equity returns. And you can't do that in a market where surety is a key component. And so if you're not bonded, you've got some sticky customer relationships with some long-term contracts, and you've got a great management team, I would say that's probably a great place to start with a company that would be saleable.
That magic phrase, reoccurring revenue.
Yeah, exactly.
That then leads to the question, I'm listening to this discussion right now. I'm looking at my company and I realize, you know what? The strength of my company is based upon what I've done and the relationships that I've established. How can I begin to move towards that reoccurring revenue model and begin to make myself more attractive? What would you say are some first steps that someone should be taking?
Well, I'll start with that, Matt, and feel free to weigh in. I think that first thing I would say is you don't change the strategy or the direction of your business to become saleable to a third party. You know what you're good at as a owner and as a business. And if you're a GC, you're not going to all of a sudden become an MEP contractor because you want to sell your company. It's not, we get this question a lot. And my view is you're good at what you're good at, and you should continue to be working on improving your capabilities in that area. But trying to change your strategy just to become saleable is not something that tends to make a lot of sense. What I would suggest is, one, really focusing on that aspect of leadership and the management team and making sure you've got good people around you is number one. If you can do that, even if you are a smaller contractor, you're going to have more people interested in you than not. But secondly, I would say the important thing is really to understand your options as an owner. Because as we talked about in the beginning, 2/3 or more of contractors are not going to be saleable. However, if you look at the return on equity of most construction businesses, it's very high. It's in the 20s, 30% on a lot of firms. And so if you can take that and show the benefit to your younger generations as they're coming in, you can begin to sell equity internally and have a good, thriving business that you can transition out of, but that also gives this younger generation some incentives to grow it over the years. And so those I would say, are the 2 things that owners could really focus on over the short run. But again, changing your strategy to become saleable is a fool's errand in my opinion.
Okay, excellent. Yeah. Your thoughts there, Matt? Go ahead.
Yeah, I'll just add. I mean, Eric, it's a great question, and I agree with everything Scott just said. It's really not about becoming more saleable, but those issues that Scott just discussed. I mean, if you want to be able to do anything with your business, right? Not just sell it, but if you want to do an internal, if you want to do an ESOP, you have to have that management depth, right? You have to have a bench team. You have to have succession. Otherwise, you're not going to have any options, right? And unfortunately, we see this a lot in our industry where, I'd say 15, 20% of all construction companies are winding down or liquidating their business because they don't have that succession. They come to us, and they're in their 70s or 80s, and we tell them that they're not saleable, because they're probably not, and we start discussing other options, and they start to realize that that's an 8 to 12 year period, and they're like, that's way too long, I want out of this in the next 2 or 3 years. And so their only option at that point is to wind down or liquidate the business. So there's certain things you can do to make you more saleable, but a lot of it is really dependent on geography. What are your markets? A lot of it's timing. And so it's really just, how do you build a better business, a more sustainable business, and management is a key component of there. Now there are other items, recurring revenue. We talk about that, right? That is more service based. You could diversify your customers and geographies, try to get into new end markets, things like that can really make you a more sustainable business. Still might not make you more saleable, but it will open up other options.
Let's explore the internal options here a little bit. You've got this internal ownership transfer. You've got the ESOP aspects. I know you guys work with both of those. You're kind of agnostic as to which one is the best. I'd like to start with the ESOP. Tell me, why is an ESOP a good option?
Well, it is a good option for some companies, and it's not for others, right? So I always kind of start there, because I want people to understand that an ESOP is not for everyone, right? Okay. And I think you'll find a lot of advisors out there that really push ESOPs, and and sometimes it's not the right solution.
So let me ask, who is it not for? Who shouldn't be doing an ESOP?
I think companies should not be doing ESOPs if they're doing it purely for the tax purposes. Right? I think that there are significant tax incentives to do an ESOP, and that can definitely lure business owners and sellers to doing it, but that's not necessarily going to create a sustainable ownership transfer model long term, right? Because that's what an ESOP is. It's just you're transferring ownership, right? And instead of transferring it to private equity or a strategic buyer, you're transferring it to your employees, right? And so that's their long term, that's their retirement benefit. And so I would say pure tax reasons is probably not the best. If you want to be out, if you're vital to business and you want to be out in 1 to 2 years, it's probably not the best fit for you. You're probably looking at third-party options there if you're saleable. So it's really doing it for the right reasons, making sure you're educated on what ESOPs are, and making sure that you're embracing the positive aspects of ESOPs.
Okay, so what are the right reasons then? You use that phrase. What are the right reasons to do an ESOP?
In construction, there's a reason ESOPs have become pretty popular, right? I mean, I think between construction and engineering, I think it's the largest component of ESOPs in the country now. 30% of the largest ESOPs in the country are in the E&C space. It makes sense, right? I mean, construction's a people-based business.
Yep.
And recruiting is hard, right? Retention's harder, and making sure that you're keeping and attracting the right people to your organization. And sometimes an ESOP can be a great way to do that. So I'd say the reasons are, if you're looking to transfer your ownership and looking to create an employee ownership culture that that you are willing to embrace and be transparent and communicate that message, an ESOP can be a great ownership transfer tool. Like I said, there are significant tax advantages to the seller. There's tax advantages for the company, and there's tax advantages for the employees. So we see this a lot with general contractors. A lot of general contractors are going ESOP. A lot of that is because general contractors are probably the hardest contractor to sell.
Yes.
For a third party.
Yep.
And doesn't mean they're bad companies, right? I mean, you could have a $300-400 million GC that really just doesn't have a third party buyer. That makes a great ESOP, because you can create a lot of value within those employees' retirement accounts, just given the return on equity that those GCs provide on an annual basis.
That's excellent. Let me ask this. Does an ownership culture have to pre-exist an ESOP, or can it be created as you kick in the ESOP process?
Always helps to have a great, culture prior to doing that. But there are so many companies that want to do an ESOP that don't necessarily have that culture, but they are committed to creating that culture.
The ones that make that commitment, what do they immediately focus on to make sure that ownership culture starts to be communicated and starts to be lived out, so to speak, as the ESOP transition is happening?
Well, as you can imagine, in any transaction where an ESOP takes place and they announce to their employees what they've just done, right? There's a lot of skepticism, by people that are working in the field.
Yeah.
Right. These are people that are working in the field every day. They may not necessarily understand the financial aspects of what was just disclosed to them. And so if they don't have trust within the people that are relaying that message, that's going to be a very tough thing to overcome. Right. And so what we always tell, and I don't do this for a living, right? There's people out there that really focus on the cultural aspects of ESOPs.
Yep.
But what we tell them, as their advisor in a transaction is you should really focus on the education and transparency piece, what you just did, right? That's not going to happen overnight. It's going to take years to create this culture, but you can take incremental steps. And part of that is building that trust level with the executive team, right? The management team really needs to buy into this, right? They need to be proponents of the ESOP because you know how things trickle down to and through an organization. And so that transparency, that education is really where that focus should be in the first couple of years.
Excellent. Scott, what are your thoughts here?
Yeah, I agree with what Matt just said. I think the cultural aspects of an ESOP are the most important. If you have the right culture and you're willing to be transparent, that's how you're going to be successful with it. But it is certainly not for every company, and it takes a thorough evaluation in advance to really consider whether that's something that makes sense.
Okay, excellent. In your experience, what are the very best companies that are going through these ESOPs? What do they consistently focus on day after day that makes that transition successful?
I think that they focus on building a culture of accountability.
Okay.
A culture of transparency. And so, if everybody now is, working towards the same goal, right? I mean, you're not just an employee anymore, right, Eric? I mean, you actually own, I don't want to get the technical aspects of it, but you are a beneficiary of ownership in that company now, right? And so if the company does well, you're going to do well. And so really preaching, how can they be more accountable, not only from a day-to-day, but how can they be more, visionary and looking at how they're spending money, and can they figure out ways to streamline things, trying to become more of an innovative culture can create value for those companies. And I see that all the time. I mean, 8 or 9 years ago, I was walking through a manufacturing plant for a really good ESOP company. And this is before I focused 100% on construction. Mm-hmm. And, an employee walked up to me and knew what I was there for, right? Because they were an ESOP and they knew that, we were, helping with that. And he was showing me how he was saving money for the company.
Interesting.
In which he knew would increase his which would increase his retirement.
Interesting.
And so you don't get that at a company without a shared benefit like that.
Excellent. Let's look at the other aspect, the internal ownership transfer. Tell me a couple of ways to structure that you guys have found to be extremely effective.
Scott and I, we've been doing internal management buyouts for a long time. And in the construction industry, there are some, unique mechanisms to do that, right? I think that the most popular one that people have done historically, I'm not saying this is the best one, but I would actually say that's not the best one, but is that just the seller sells for a note and kind of walks away, right? It's the easiest. It's the one most, probably advisors or accountants are telling their clients to do, but there are a lot of, pros and cons to doing that, so you can sell. You can sell internally to your management with bank debt, or you can do it all with a note. There's JV structures out there that we've structured called oldco, newcos. And then, the most flexible one is just doing it through kind of some sort of S corporation, or whether you're an LLC or an S corporation, through a long-term, annual buyout where every year you can add new buyers, new sellers, and really using the cash flows of the company to effectuate that transaction. And before I hand it, because I know Scott will have a couple comments on this. At the end of the day, an internal transaction, Eric, is really, and sellers really have to understand this, as you're really buying yourself out with your own money.
Yeah.
Because most of the time, management, they don't have money. They don't have the money to come in and make a big acquisition or a big purchase of stock. And so where are they getting that money? Most of the time, it's just coming through cash flow that could have went in the seller's pocket that's now being used to effectuate that transition.
Okay, excellent. Scott, your
Yes.
thoughts?
Yeah, the only thing I would add to that is there is never a one-size-fits-all approach to internal ownership transfer. It really depends on the timing objectives of the owner, who the potential buyers are, and as we talked about before, who's qualified to be a buyer, who's qualified to run the business going forward, and that is often the most difficult part. But there are dozens and dozens of mechanisms for transferring equity internally. The challenge is that they all take time, and they all take people to come up behind you as an exiting owner to make sure that you get some value for your stock. And so, to Matt's point, you can always structure something as a note. Most sellers don't like that. They want to continue to benefit from the distributions and profitability of the business as they're transferring ownership. And there's a number of different ways to do that. But at the end of the day, it's about people and it's about what you want out of the business over time. And it's unfortunately not something that happens overnight, right? It's, as we said before, it's an 8 or 12-year process, typically on average. Sometimes you can accelerate it, but it really is it's just dependent on your objectives and what kind of team you have in place. And that is where we spend a lot of time.
Okay. So let's talk about that. As you're spending that time, what are the hard truths that you're telling construction company owners that they don't want to hear perhaps, but they need to hear?
That is it. Let me give you an example of one that we're seeing a lot here recently. I think a lot of construction owners have heard this message before, that you have to have a team in place that's ready to come in and buy your stock, right?
Yep.
And they will occasionally bring us in and we'll start having conversations with those incoming owners. And I'll tell you what's happening more and more is, particularly with bonded companies, we are going in and talking to that next generation and saying, okay, we understand that you've been told that you could be a prospective owner in this company. How do you feel about signing on the dotted line for surety risk, and that you could lose your house, you could lose your car, you could lose your retirement savings, everything if a job goes bad? And more incoming owners do not have the risk tolerance to sign on the dotted line. And so what we preach to all of them is start very, very early. Start 10, 15 years out to know A, what your options are, and then B, to really begin having conversations with people about what it means to be an owner, to have them understand not just the day-to-day operations of the company, but also the overhead structure and management of the company. What is a surety bond? How does it work? What does it mean to an owner? Who are the banking relationships? Who are the insurance relationships? All of that, to make sure that they have a really good handle on how the company is run, because it's not just about having guys who can run projects. It's about having guys who can run the company. Yeah,
that's really interesting. I'm curious, in your opinions, do you think the lack of tolerance for risk, is that a generational thing? What are your guys' thoughts on that?
That's a great question. I don't know the answer to that specifically, but I think it is partly generational. But that being said, I think you have in the construction industry, as we mentioned before, there's 800,000 contractors out there, right? So people do often go out and start their own thing. Yep. I think what happens is that people get comfortable, particularly those who are well compensated.
Yes.
Right. So if you're being very well compensated, you're making, $200,000 or $300,000 a year in a construction business, and then somebody comes along and says, all right, now, you can make more money, but you're going to have a heck of a lot more risk. Some of them say, hey, I'm pretty comfortable with but I think it's something that, we seem to be seeing more often here recently, and it's something that everybody needs to be prepared for.
It's interesting that you make the excellent point that you need to educate people not only on how to run a project, but the construction business itself, and tell the truth about those aspects of the business that are uncomfortable or do create that risk intolerance. You know what I mean?
Exactly. I think the challenge is spending as much time as you would on thinking about how you're going to transfer ownership. Really, you should be spending an equal or much more amount of time on how are you developing those leaders in the company going forward. That should be a real focus of the company, and partnering with folks who understand that and can help you develop your leadership team so they're in a position to do something.
Okay, so let me just do a little summary of where we're at so far. The big thing that I've heard again and again is this aspect of time. 8 to 12 years minimum. Then you've got to have a strong culture to make the company either attractive to outside sellers or even attractive to people wanting to do the ESOP or an internal sale. Then you have to structure the company correctly in terms of a niche or in terms of the type of work that you're doing. And then you need to develop your leadership, not only to build projects, but also to understand the business. Am I hearing hearing it right as far as what you guys are sharing with me so far?
I think that's right. There's a couple apples and oranges in there. And one is more third party oriented, one is more internal oriented. But at the end of the day, focusing on people and culture and developing the individuals who can come up and either succeed you from a management perspective or from an ownership perspective or both is critically important to this whole thing, regardless of what you do.
Okay. Let me ask you this. In your experience, have you ever worked with companies who have committed to a particular line of a particular structure in terms of the sale of the business, and then they've reached a point where they see this is not working, and then they've successfully pivoted to another structure and been able to negotiate an exit? Have you seen that before?
Absolutely. And it really varies. But we were talking to a client a couple of weeks ago who had begun selling ownership internally, and they weren't getting the desired results that they hoped in terms of the incoming owners really taking responsibility and adopting that ownership culture amongst themselves. And so they were talking to us about a potential, third-party sale of the company. And so we do see that from time to time. Fortunately, in this case, it's a company that very much has a third-party sale option. But in many cases, that third-party option is not out there, and it can put you in a very difficult position. And so, like we cited before, I think planning in advance is a really key component to this whole thing, and understanding your people is a key component to this. Matt, have you ever seen anybody go internal and then move over into the ESOP side of things?
Yeah, I mean, that's definitely happened as well. And I would just add, Eric, that this is why it's so important to be getting good education before you start going down a certain path.
Yeah.
Right? Because it is, yes, there are success stories, but it is much more difficult, sometimes to unwind what you're already doing to go another path, especially if there's been promises made and things like that. So that education piece is so important that clients, and construction owners really know what they're getting into. We worked with one a few years ago where the owner sold to one key executive and did a sale for a note. At that point, it's pretty much done, right? Well, about 3 years into it, he realized I sold to the wrong person.
Yep.
Right. And not only did I sell to the wrong person, not that he didn't want this person involved in the company, but he wanted broader based ownership. The other executives were upset about it, and it was creating this cultural aspect. So we had to unwind that and figure out another structure that worked for what they were doing. Now, when there's legal agreements and all that in place when you go down that path, and so it was a lot of work to unwind that. Unfortunately, we caught it early enough where we could structure it differently, but that is something where if the owner, could do it over again, he probably would have just done it incrementally, to start off with.
Is that why an ESOP is sometimes better, because you're not putting all your eggs in one basket, so to speak, or 2 or 3 baskets?
Yeah, I mean, ESOPs can be great for a lot of those situations because, we've talked about, a lot of these management teams don't have the money, to buy in, right?
Right.
Or they don't want to take on that personal risk. And in ESOP, you can really, those executives will probably have less upside in an ESOP.
Yep.
Right. Because they're not going to own 50% of the company, but they can get, ESOP shares, they can get management incentive plans. There's a lot of things that you can get in an ESOP that is an incentive for those key executives. ESOPs operate much more like publicly traded companies, Eric.
Yeah.
There's a board that kind of runs makes the decisions. Then the management team is more compensated with salary bonuses and options and things like that. So yeah, I mean, that's when we talk to business owners who are thinking through internal options and they're kind of weighing that ESOP versus selling to the management team. The management team a lot of times will drive that discussion. Because we're not the ones that are trying to push it. We're letting them know that the management team is really uncomfortable with a management buyout, and they'd feel more comfortable with doing an ESOP.
It's interesting because I think that's one of the biggest challenges. We talk about this time aspect. We talk about identifying, let's say you're doing an internal sale, a group of people or maybe 1 or 2 folks. But that one issue there of I've identified this person, and then time passes, life changes, life circumstances change, and my hopes and my dreams are now being shattered because I've got the wrong team in place. Is that something you see very often, or give me just a little bit more on that, please?
Well, I'll let Scott chime in here in a minute. I mean, I don't see that as much, fortunately, right? I mean, I don't personally see that as much. I think it's unfortunate when you see that happen. And, that's these business owners, a lot of the times they care about their legacy, right? I mean,
Yep.
a lot of construction companies are named after the founder. Right?
Yeah, right. Yep.
It's always, it's like 90% of the time it's their last name.
Yep.
And so they care about their legacy. They care about the community. They care about, and all of a sudden they're, making a decision to sell the company and trust that company to these, either one or key executives, and they realize they totally screwed up. I mean, that's got to hurt for them, and it's not it's definitely not what they planned for.
Right. Scott, what are your thoughts on that?
Yeah, I would say I don't care whether it's an external transaction or an internal transaction. There is always an element of trust to any deal.
Yeah.
We can paper things up from a legal perspective in a wide variety of ways and protect people legally as much as possible. But at the end of the day, it's about trust. And you've got to have, if you're doing something internally, or even if you're doing something externally, you've really got to get to know and understand who that buyer is and what their intentions are. And then at some point, you've got to take a leap of faith. And I've seen both internal transactions have really real issues with the people that they have chosen to be the next generation of owners. I've also seen external transactions have real challenges where the buyer turns out to be not quite as pleasant as you thought they were during all of the management meetings, and they come in and end up suing you after the closing for whatever reason. It really at some level requires an element of trust and making sure that you understand who's coming in to buy your business and whether you think that's somebody that is worthy of taking over the reins.
Yeah. How much work have you done with companies that they're family-based companies and the dad sells to the son or to the daughter? How much work have you guys done with that? That's
a big percentage of what we do, and that there's a wide variety of structures and family gifting and things like that come into play there. But our advice to clients is always to treat those family employees just like regular employees. First off, in fact, we recommend that if you have kids within the business, to send them away from the business for some period of time to go work elsewhere, so they understand how other companies operate and they're not just exposed to this one world, so to speak. But yeah, it's you have many of the same challenges, except in some cases you have even more challenges because the kids of an owner typically are not too hesitant to criticize, right? And so it can be typically a more challenging process in many ways.
Interesting. Yeah. So as we're wrapping up here, go ahead, please. No, yeah, go ahead.
I would just say that, the statistics are showing that less and less companies are transferring ownership to the kids, right? Compared to what it used to be, right? So that number is continuing to go, dwindling as, especially in our industry, if you think about, a lot of these kids don't want to be in the business, right? They don't want to be in the construction business. They're doing something else. And a lot of these companies are realizing that for them to grow and for them to retain talent and stuff, they have to have more broad-based ownership, right? If they're going to have the good management, the good project managers, the good whoever. And so we're seeing that be a smaller percentage of transactions and internal transfers. Doesn't mean that they won't be a part of it, but to go from father to son, 100%. We're seeing a lot less of that.
Excellent. So as we're wrapping up here, gentlemen, what are 3 action items that I, as a construction company CEO, need to start immediately in the next 6 to 12 months to begin this process of transition, to begin this process of setting myself up for success for whatever type of transaction that I choose to use to sell my company?
I could start with 2. I think the first one is really working with someone to understand, is my business saleable, and somebody who actually understands the market. And then number 2, to really be looking at the management team and understanding who is going to go where over the course of the next 10 to 15 years. And that, I understand, is very unpredictable, right? People come and go on a very regular basis, but really beginning to look at that bench and evaluate how are people going to progress in their careers? Where do you see them going? And really make sure that you've got a good bench to potentially sell the business going forward, whether it's going to be internal or external. And I think if you understand your options and you've got a good team around you, you're going to be fine. It's when you ignore both and you get to be 65, 70 years old or whenever you want to retire, and you say, okay, I'm ready to get out of this thing, and you haven't paid attention to either of those, that's when we just don't find a lot of options for owners. And I think those two are very simple. There's a number of other things we could talk about, from getting the personal expenses out of the business and, other things like that to clean up the business to get it ready for a transition. But to me, those are the two big ones. And if you're focused on those, everything else we can typically work through.
Matt, what do you want to add to that?
Yeah, I agree. I agree. I think the biggest advice I would give is, if you're in your 50s, it's a really good time to start planning. I think it doesn't mean you have to start doing something, but you should definitely start that planning stage of at least understanding what your options are, so that when you are ready to retire, let's say 65 is when you want to be out, right? You're working your way backwards, 8 to 12 years, so that when 65 hits, you're really going to have, all of the options, regardless if you're saleable or not, right? Yep. You should be planning, because if you're saleable, great, right? To Scott's point, you really have to have that, no matter what you're doing, have that management depth, and it's never too early to start working on succession. And I think good boards, if companies have boards, and if you don't have a board, I highly recommend privately held companies start to have more formal corporate governance. And I think that good boards are really driving succession at the management level, taking, whether it's your 5 or 10 key people, and making sure that they have a successor to each one of those positions.
Okay, so let me ask you that question then. Tell me the ideal makeup of a good board.
I don't know if there's an ideal makeup of a good board. Let's just put it this way, Eric. Majority of privately held companies don't even have a board.
No, they don't. I know.
So I think the fact that if you just established a board, with 3 to 5 people, typically you want it to be, an odd number, so there's a tiebreaker.
Yep.
There is, I don't know if there's an ideal number there, whether it's 3, 5, 7, 12, whatever. But having a board and trying to bring at least one external board member to the team, I would say that is a best practice. Somebody that really knows the industry, can help you think your growth and strategy plans. That maybe, as you've been in this business for 30, 40 years, maybe you're not being able to see the bigger picture because you're so focused on what you do. These people can bring a different outlook and really help the company think through some of their internal issues.
Beautiful. Scott, your thoughts on that?
Yeah, I would emphasize that. I think the industry is going through some pretty remarkable changes right now, and will be over the next 10 to 15 years, whether that be the labor situation. I think we're going to see a lot more integration among companies just to alleviate some of those labor strains, not to mention the fact that, you look at the transitions that are going to happen. I think I saw a statistic the other day that by the year 2030, the entirety of the baby boomer generation will be 65 years old. So that's 9 years before all of this transition really begins to happen or finalize, I should say. And the other piece is technology. I mean, look at what's happening with technology in the construction market, and having somebody on your board who has that outside perspective and maybe has some exposure to different industries and how they're implementing some of these things, I think would be enormously valuable with most firms.
That's very, very interesting. I'd like to just go back to this idea of integration. Do you foresee that being a means of transition also, where two companies come together and they sort of take the best of their management and leadership team and get a transition going that way? Do you foresee that at all?
That's somewhat of an acquisition or a merger type of concept that you've alluded to. I think what we're seeing is that the bottleneck in the supply chain right now for construction is labor, and has been for a while.
Yes.
And so what we have seen are specialty contractors adopting more of a GC approach, so that they can take a couple of more points of margin off of jobs, right? Yeah. And we've also seen more and more GCs trying to self-perform, whether it be concrete or other functions within their projects. And so I think that trend will likely continue. And then you look at just the number of firms that are going to transition here over the years. And I think a structure that you alluded to would make a lot of sense for some firms. But again, merging companies you think deals are challenging. Mergers are even harder among construction firms. But that being said, I think strategically there's a lot of things happening in the market that are going to change people's perspective here over the course of the next decade.
Interesting. So I really like those two specific points there. Understanding your options, having a good team. So tell me a little bit more about what you guys do, what BaseRock does to help people to understand their options?
Sure. So we formed BaseRock with the purpose of providing firms with their full suite of options for ownership transfer. So we provide M&A capabilities, we provide ESOP capabilities, and we provide internal transfer capabilities. And our objective is to go into an owner's office and do some homework and be able to go into them and say, look, here's what we see as the options. Here's what we see as the total proceeds in a potential transaction incorporating our view on valuation. And then also talk about the timing of each option. And then to the extent that we get into it, even talking to some of their people to understand the feasibility of something internally or even an ESOP. And so that's the approach we take with clients. And obviously, if something is a third-party sale and they want to go down that path, we have a depth of experience in that market that we think is unparalleled in terms of our relationships in the industry and the number of transactions that we've done over our careers. And so that's the reason that we formed the company. And I think we're probably the only firm out there that really can provide all of those options at the same time and assist owners in really becoming informed on each of them so that they're not entering this process blindly.
Okay, so you're agnostic in terms of which particular method to use. You like to present all of the options that are available and advise people based on the structure of their company.
Exactly. I mean, owners almost always have differing objectives about what a transaction should be for them. Sometimes it's getting a kid into the business. Sometimes it's key management, making sure they're taken care of. Sometimes it's making sure the business name lasts. Sometimes it's selling to a particular company that they really admire. And then for most of them, there's obviously the total proceeds equation of a transaction as well. And so, there's different tools for different objectives. And that's what we're trying to do, is bring all of those tools into a project and solve for the challenges that each owner faces.
How long does it take you guys usually from first interaction with someone to recommendation? How long does that take? I'm just curious.
Matt, you want to cover that one?
Yeah, I mean, it really varies there, but we typically we'll do some sort of kind of upfront analysis in a couple months.
Sure.
We have to get to know the business and objectives and it's a lot of the times it's not us coming in and saying this is what you should do, right? It's really hey, here's your options, here's the pros and cons to each. Let's have a Q&A and start going through each one of these and ultimately let the business owner make that decision that they feel is best for their family, their community, their company, and their employees. We just want to make sure that they have all of the tools available and understand what those options are. I mean, too often in our industry, in the investment banking world, one thing, it's M&A, it's ESOPs, it's internal, right? And so, people are typically kind of pushing what they know. Well, we can execute on any of those. So we don't really care what they do. We just want to make sure our clients are making decisions that they can sleep with for the long term.
I like that thought. Decisions you can sleep with. That's beautiful. So how can folks get in touch with you, please?
Sure. So we have a website, which is www.baserockpartners.com. And then and that's probably the best place to reach us. And our phone numbers and emails are all on there.
Beautiful. Yeah. So we'll link to baserockpartners.com in the show notes. As we're wrapping up here, gentlemen, I see you guys are in Denver and St. Louis. Matt, where are you located?
I'm in St. Louis.
Okay, so Matt, I'm in St. Louis. What's the best barbecue joint I got to hit if I get to St. Louis?
Oh, best barbecue. Oh my gosh. Well, so I am not a St. Louis native, but I've lived here for 3 years. And my favorite place, there's two of them. I like Pappy's Smokehouse, and Salt and Smoke are probably my two favorites here.
Pappy's Smokehouse, and what's the other one?
Salt and Smoke.
Salt and Smoke.
Yeah, they just opened a new location right by Busch Stadium. So if you're coming to a Cardinals game, hit up Salt and Smoke.
Beautiful. Links in the show notes to those places. And so, Scott, what about you? Are you in Denver?
I am just outside of Denver. Yep.
Okay. So what's the restaurant I should hit if I'm in Denver?
That's a good question. I'd have to give that some thought, Eric. It's there's a lot of choices down there in Denver, but we are. There's a great barbecue joint up here in Broomfield called GQ, which is fabulous and won a lot of awards. So we go there quite frequently. But and there's a lot of great spots now down in Rhino and downtown that are popping up. So Denver's becoming a much better food destination than I say it was 10 or 15 years ago.
That's beautiful. Well, Matt and Scott, I really appreciate your time. Your insights have been extremely helpful. And make sure there's links in the show notes to get in touch with you. And look forward to talking to you again soon.
Right.
Yeah, thanks for your time.
Thank you.
Eric.
Today's episode was brought to you by the Construction Conclave. If you as a construction leader would like to develop your skills and get involved in a community of like-minded construction professionals who are focused on building healthy teams, profitable projects, and long-term successful businesses, then the Construction Conclave is for you. It's a private, invitation-only group of construction leaders that are focused on developing their leadership skills. We do training every single month online that looks at how to become a better leader in a very practical, straightforward way. We also have other events that build community and camaraderie so that you can associate with others who are interested in developing their skills as leaders. If you'd like more information and to see if you qualify for participating in the conclave, feel free to reach out to me, eric@ericanderton.com. Thank you for listening to this episode of Construction Genius. Hope you found that 1% of inspiration to help you in the next few days. If you like the show, please give us a 5-star review on iTunes, share it with other construction leaders who you think would benefit, and thanks again for listening.